I just don't believe the strait is going to remain closed. It will be reopened. I don't think Iran is going to be involved in terms of deciding who goes through and who doesn't.
Is there an off-ramp for the United States now that doesn't involve escalating the war or putting troops in the ground?
The answer to your question is no. The credibility hit that the U.S. would take, I think, is unacceptable. If you look at the S&P, every high is lower, every low is lower, which is a definition of a downtrend.
Is there a level at which you will feel comfortable adding more gold?
I think there's a chance that it'll dip below.
Jim Welsh returns to the show. He is the author of Macro Tides, and he's been a macro and technical strategist for the better past couple of decades. Welcome back to the show, Jim. It's good to see you.
You just shaved about 20 years off my age, David. Thank you for that. I'll be happy to come back anytime you want.
You still get ID'd at bars? I'm kidding, Jim.
Well, in some places, it's like, well, that's the law. I got ideas. So the top here doesn't help at all? Give me a
I'm very excited to have you back on the show because you've been right. And let me explain what that means. You were on the show earlier in the year in January. You had said that the S&P looks like it's technically on the decline. It's about to decline another 37%. We're now down 7-8% from the start of the year. So is this the end of this retracement for you, Jim? Let's start there.
When you say retracement, the rebound that we saw off the recent lows?
Well, is this the end of the bear market for the S&P that started late last year?
Yeah. Well, my take is that obviously the Middle East situation is the critical determinant. I think those who have been expecting Trump to, as I like to say, chicken out, are wrong. But what I pointed out is if you look at the S&P, every high is lower, every low is lower, which is a definition of a downtrend.
Yeah.
The market got pretty oversold. There was idea that, okay, maybe we're going to have peace, and you had this huge rally. The S&P was up, I think, intraday from low to high about 4%. The 50 most shorted stocks were up over 7%. So there's no question, David, some of the strength we saw earlier this week was the result of short covering. March 31st, end of quarter, so mutual funds doing some rebalancing, and then maybe a small amount of buying of people that feel like, okay, you just don't know. My take is there's more to come in the Middle East. I don't think Trump is going to back out prematurely for a lot of reasons. Saudi Arabia and a couple other countries have kind of said, please finish the job. If we don't, I think that will potentially alienate them. So I think we're going to finish the job, whatever that entails. So that implies that there's more to come. And what we don't know is how much firepower does Iran still have. One key area, David, in my view, is Saudi Arabia has a 700-mile pipeline called the East-West Pipeline. And a month ago, that was about 1 million barrel capacity. They're now doing 7 million barrels. And it exits out the Red Sea. Mm-hmm. So that is a lifeline for, obviously, oil supplies. I think they're shipping about 5 million barrels. The problem is the Houthis do have missiles from Yemen that could reach that pipeline. So if the hostilities ramp higher, one of the key questions is, will the Houthis try to destroy or damage that pipeline? If they do, oil prices are going to spike. And I think potentially, people may not remember this, but in July of 2008, oil got up to $147 a barrel. So there are some skewed risks here over the next week or two that just have to be dealt with and accounted for.
When you say that Trump is going to finish the job, we don't know the timeline, but if that's your thesis, an investor such as yourself would naturally want to be positioned long to prepare for an eventual end of the war, which would boost markets. Would that make sense to you, Jim?
Yeah, it does. It's just that the knee-jerk reaction. I mean, think about it, David. To some extent, I think a lot of people have assumed that this war would be over quickly. Trump said 2 to 4 weeks. And they know that at the other side of this thing, there should be a fairly significant rally. And they don't want to miss that. And so perversely, that's why the decline that we've seen since late February is so choppy, because people are hanging in there in anticipation. I just think there's the risk that there will be one more escalation, and what happens in that could cause one more sell-off that takes the S&P down closer to 6,000, maybe 6,200, give or take. And then I think the market will be in a much better position to rally more sustainably. I just think there's one more shoe to drop.
Is there an off-ramp for the United States now that doesn't involve escalating the war or putting troops in the ground? In other words, is there an option for Trump to just pull out, I guess, and stop hostilities without damaging alliances and without further damage to global markets?
Well, the markets may like it, but I think the answer to your question is no.
Okay.
I just, again, the credibility hit that the U.S. would take, I think is unacceptable. Somehow, some way, we need to get our hands on the uranium.
Well, when you say finish the job, what does that actually mean? Because Trump has been declaring victory pretty much every single night for the last 3 weeks now.
Yeah. I think, as observers, we have to take a lot of what President Trump says with a grain of salt. At the same time, we're in a world where that media is connected in ways that certainly wasn't 50 years ago. All right. So journalists sometimes expect him to lay out what our plans are. Give us a date and time. Well, that's just foolish. I mean, that's borderline stupid, actually, in terms of, let me tell our adversary, we'll be there around 12:05.
Yeah.
Are you kidding me?
Yeah.
Okay. And so to me, he is going to say some things. And unfortunately, the media often takes the bait. And then there's like, oh, my God, he said this and then they did that. No, well, come on, folks, grow up. This is a real world, obviously, issue. And he's not going to play out all the cards on the table for you to report on. And so to me, what needs to happen is somehow, some way that uranium is essential. Because if you leave Iran with that uranium, it then is a much shorter runway for them down the road to be able to convert that to some kind of a nuclear weapon, whether it's on a missile or in a baggage, a piece of luggage that gets dropped off at JFK, two different things, but still very lethal. So I think that is one of them. Obviously, the strait has to be reopened. And guess what? Iran's not going to be charging tolls for every ship that goes through. So I think Trump's efforts to engage and get other countries involved is a positive step, because for decades they've relied on the U.S. to do almost everything in terms of providing security around the Strait of Hormuz and in Europe as well. And so I think it's constructive, David, yesterday, after Trump made some of his comments in his speech, lo and behold, 40 countries got together to say, okay, what can we do? Much like in Europe in 2018, Trump criticized NATO for not spending the 2% of GDP on defense that they were supposedly obligated to. And they did this. And guess what? Within a couple of years, they ramped it up. And now they're talking about, I think by 2030 or 2032, up to 5%. So these are kind of a reordering of the global order that I think are really constructive longer term, with Europe assuming more control for its own protection from Russia, and also contributing to opening up the strait, because they're way more dependent on the products that come out of from the strait and through the strait than the U.S. is.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colamac are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Colamac spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. Trump in his speech last night said the United States imports almost no oil through the Strait of Hormuz and won't be taking any in the future. We don't need it, we haven't needed it, and we don't need it. So he didn't offer a clear plan to reopen the Strait of Hormuz, like you said, and he mentioned that allies need to take more responsibility. However, the truth remains, Jim, it doesn't matter who takes responsibility. If the strait isn't opened, oil goes higher. WTI, after that address to the nation, spiked up to above $100 again. And so even if the U.S. doesn't need oil from the Strait of Hormuz, it still needs oil to come back down. Otherwise, ordinary citizens will have less money to spend, which is not good for the midterm election, by the way. So yes, he does need the strait to open, even if we don't need oil directly. So what are his options now?
Well, again, I think we need to kind of look at it a little bit differently, Davey, from a standpoint that as oil is doing this, it's hurting other countries that haven't come to the table more. So I think the U.S. has the capability of opening the strait, given the assets that we have there. You know, on March 31st, the war's going to end. Well, another aircraft carrier left Norfolk, Virginia, on its way conceivably to the Middle East. We're going to have 3 aircraft carriers. So again, I think keeping oil prices high, seeing jet fuel inventories run down in Great Britain, you know, those are significant leverage factor in terms of we do need to do something. And so I think the U.S. does have the capability of opening up the strait. I think President Trump is using that leverage of oil prices and availability of byproducts from oil as a leverage point to say, you need to step up. And with the oil prices going up like that and the clock ticking on availability, guess what? 40 countries got together. So I think people have to understand, you know, people look at that and say, well, you know, we're kind of, you know, ticking our good friends off, you know? And it's like, yeah, well, good friends have your back. And this is a situation, yes, did President Trump initiate this? Yes. At the same time, some of these countries are going to be big beneficiaries if Iran no longer has the threat and leverage over the strait. So, you know, it's kind of like face the music. And I think oil prices is the leverage that President Trump is using to bring some of these countries to, you know, like, okay, guys, it's time for you to show up. And I think they will.
Let's go back to the markets now. What do you think the S&P 500 is going to respond to most in the coming months? Iran war, triggers for up and down movement either way. We haven't talked about the Fed monetary policy yet and liquidity conditions. What will move the market in the next 3 months, Jim?
I think the main thing is oil prices and obviously the war, because those are pressure points. Not, you know, they're pressure points in the U.S. As you noted earlier, gas prices going up is a squeeze, but it's on the lower income folks as opposed to the upper middle class. You know, they're in much better shape. So the bifurcation of the U.S. economy, where you have the top 10% account for 50% of all consumer spending. And so that bifurcation is, if you will, get intensifying because of this. It's interesting, David, despite all this, earnings are expected to be up 13% on the S&P this year. So that is the other potential risk out there. If, for whatever reason, the war extends much longer and we really start to see a hit to the economy and earnings have to start coming down, then that's another potential selling pressure point for the market. What we've seen is PE ratios. Earnings are expected to be up 13%. The market's declined because PE ratios have come down, especially for the Mag 7 stocks, and they comprised about 40% of the S&P. So you have this faith that the economy is going to be okay, is going to weather this. And there's justification for that. If you think about it, the deficit this year is going to be almost 6%. The AI spending is not going to be impacted by what happens to oil. Those companies are going to spend the money, and in total, that's about 1.6% of GDP. The top 10% are decent as long as the asset markets hold up all right. The one big beautiful bill is estimated to add 0.6 to 0.7 to GDP, you know, the tax cuts and so forth. So the economy has some built-in cushion, if you will, to absorb what's happening with energy prices. If that starts to erode, that would be another problem 3 to 6 months down the road. The other issue is the average decline in a midterm election, David, is about 17%. And I think it'll take a miracle for the Republicans not to lose the House. There was a poll out this week that showed that the Dems had a 51% chance of winning the Senate. If they do that, they're going to, embark on a scorched earth policy.
Yeah.
And so the markets, I think, there's going to be more volatility. In other words, we get through the war, then all of a sudden the midterms are going to be on the radar screen. Right now it's out of sight, out of mind. We get closer to July and August, and those polls start coming out, the market's going to respond.
How likely will the Fed raise rates this year?
I think it's really low. And the reason is historically, other than in the 1970s, the Fed kind of learned that when you have high oil prices, and you alluded to this point, there's demand destruction. People are spending money on energy. We're not going to go out to dinner this week a second time. They can't afford to do some things they normally would be doing. So within, higher inflation, but that is going to cause some pockets of economic weakness. So the Fed will choose to look through this. What they will do is the statement from the next meeting in late April will be will have much more tough language included. We'll see FOMC governors and the presidents of the districts talk, you know what? We're committed to that 2% target. And look at what we did in 2022. We raised the funds rate of 425 basis points. And if necessary, we're going to do it again. And so they're going to jawbone as much as they can to convince markets that they're not making the same mistake they made in 2021. And so and the 10-year Treasury yield will be kind of the barometer in terms of how successful they're being. If it continues to work its way higher, it gets above 4.5%, stock market's going to pay attention to that. So there's a lot of moving parts that are going to evolve over the next 3 to 6 months that have the potential of causing the market more difficulty. So until we see more concrete evidence that the momentum has shifted from every rally being sold to where, hey, we really have reasons now to buy every dip again, I think you have to be defensive.
Defensive in what way, Jim? By being out of the market or investing in certain defensive assets?
Both. I think raising cash, my expectation back in February was that the S&P was setting up for a pullback. And if we took out 67.70, then we would see a decline to the 65.20. What happened on March 6th? And I also said, hey, if oil gets above $80 on WTI, that's a problem. On March 6th, WTI got above 80 and the S&P took out 67.70. On March 5th, I sent out a special report saying, you know what? 65.20 is not going to hold. We're going to see more selling pressure come in. So, to me, again, raising some cash in terms of some sectors, look at how gold has performed. This is serious stuff. Gold hasn't performed all that well. In early March, after gold popped on the news of the war to, I think it was a 54.19, my take was we're going below 46.56 because the pattern was such that you had this huge drop from 55.95 to 44.07. I thought the bounce to 5,400. I thought it would maybe get to 53.40 initially. It spiked a little bit above that. Is part of a much bigger multi-month correction in gold that I think could last another 6 to 9 months. Either a lot of sideways chop or a drop, down to 4,000 and it's possible it could be even a little bit below that. So I think that gold is going to go down again in coming weeks. The other issue is the dollar. My take has been constructive on the dollar since the low in January. From that low, David, you can see 5 waves up on the dollar index. What that suggests from a pattern analysis is that after whatever pullback we get, we're going to see another push higher. That next push higher will take the dollar above 100.50. And I think that's one of the reasons why we could see thanks for pulling it up. The dollar 1, 2, 3, 4, 5 up. And so what that implies is, could we get to a move up towards 107? Because if you connect the high from September of 22 was about 114.70, and then the high in January of last year was 110 and change. That line comes through at about 107.60. So I think there's the potential that you could see the dollar spike that high. At a minimum, I think we're going to see another rally. 103 to 104 should be achieved. If that happens, I think that provides downward pressure on gold and obviously emerging markets. Everything that has benefited from a weaker dollar will have a setback.
Look at this long-term chart of the U.S. dollar, DXY. Ebbs and flows over the last 40 years. I've just overlaid this with the Fed funds rate, and you can see how the policy rate of the central bank really affects demand for dollars in the long run. Given this, do you ever see a situation in which the DXY returns to its pre-2008 financial crisis level of 120?
Around 70.
It's at 100 now, going back to 120.
Yeah. Again, my take is I think it can rally to that downward trend line. Yeah. And then what happens if it gets there, what happens at that point, David, would be very, very instructive in terms of if it can blow through that, then all of a sudden it move back up to at least the high 114s, and ultimately is the 121 high from, I think, what was that, 2001 or 2, something like that, when George Bush Jr. was in office. So for me, you got to take it one step at a time. The world still uses the dollar for the vast majority of all trade. President Trump is taking steps to kind of neutralize some of the things China has done to develop the yuan of being playing a greater role in world trade, particularly in oil markets. So I'm not in the dollars going to hell in a handbasket, because to me right now, as best I can see, I think the probability is we'll see the dollar break out to the upside, and then we'll just see if it can follow through. For what it's worth, when the dollar was up around 114, I wrote in my letter a drop to 105 was coming. In January of 2025, in my letter, I said a drop to 95 is coming. Why? Well, because the decline from 114 down to 99 is 15 points. Subtracted from 110, 95, what was the low in January? 95.58. So that's another reason why the dollar went from a correction of 114 down to 95 over about 39 months. Ironically, Barron's about a month ago had a cover story about the demise of the dollar. Mm-hmm. Now, it had been going down for over 3 years. It would have been helpful in January of 2025 when it was over 110 for them to say that. So those are again, signs from a psychological standpoint that people are positioned for more dollar weakness. I've seen in the last 6 months more stories about the dollar losing its status as a reserve currency, blah, blah, blah. People position for that kind of stuff. And that potentially is fuel then for a rally. And I just think that's still the way it's more likely to play out.
Well, the DXY is still, again, above 100. So I don't think the markets are pricing in a scenario in which the petrodollar is gone. Because right now, the Iranians want to charge a toll, and for that toll to be paid in either yuan or cryptocurrency.
Right.
Not the US dollar. So if countries shift away from using the dollar to pay for their oil, that's the end of the dollar as a reserve currency.
Not going to happen. I think, you asked earlier about what's tenable. Iran is, okay, we'll work with Oman and we're going to have a toll booth set up. I don't think the world is going to accept that. Period. I don't think the other Middle Eastern countries are going to accept it.
I'm sorry, Jim, but okay, they're not going to accept it, but what practically can they do about it? They have to get oil from that choke point, and they don't want to get shot down by missiles. So they're going to pay a toll. It's cheaper, right?
Yeah, but, the world is changing, David. I mean, I believe, what Iran wanted was to do exactly what you're talking about, dominate the Middle East. And for a couple of decades, we're working toward that. Well, everything that they wanted to do has been set back. And I just don't believe the strait is going to remain closed. It will be reopened. I don't think Iran is going to be involved in terms of deciding who goes through and who doesn't. You asked earlier about what are some of the longer term goals for maybe what Trump and other Middle Eastern countries have. Well, that's one of them. No one, this is a window of opportunity to really change the dynamic that's been in place with Iran and the Middle East for 20 plus years. I think they're going to try to seize that window of opportunity. I think the probabilities favor them being successful in doing that. But there's also the probability, even though I think it's much smaller, that maybe it won't play out that way. So, Iran attacked 14 other Middle Eastern countries. That's not how you win friends and influence people to your camp,
Yeah.
So, but it also bespeaks to, like a wounded animal. You get it cornered, what does it do? It lashes out. And that to me is the risk of the next 2 weeks or so, is as the game is pressed against Iran on multiple fronts, how much firepower do they still have to lash out in an effective way? And if, as I said earlier, they take out that east-west pipeline, that would be a significant oil shock, at least obviously over the next 6 to 12 months.
So then you say gold's going lower. A few questions on that. Well, gold was traditionally seen as a safe haven asset. If it's going lower in times of turmoil, like right now, where do we go for safe havens, for safety? Besides cash, which we talked about.
Yeah. Well, again, longer term, I still believe gold will ultimately make a higher high above that number, but we did see a parabolic spike into that high. Sentiment was like ridiculously bullish. So historically, you need to work that stuff off. The fact that gold hasn't responded more, given everything that's happened, guess what? If some measure of peace breaks out, what direction do you think gold's going? The Strait of Hormuz opens up. Is that going to be a positive for gold or a negative for gold? I think it'll be a negative. So then you get the people who bought it, at 4,500, 5,000, all the way up, and it doesn't reward you, and some of the props get removed, and the price starts to work against you. You say, well, this ain't working. I'm going to have to sell some of my gold. So there are pivot things that I think in the near term can cause more weakness. And going back to December of 2015, gold bottomed at 1,046. It rallied to a little bit over 2,000. I think it was 2,070. And then it had a 2-year pullback for what would be a wave 2 into the low in September of 22. So wave 4, this is wave 4, it should approximate wave 2's time frame. Well, I don't think it's going to take 2 years, but a year to work all this out potentially, that to me is certainly plausible. So I'm just going based on what the charts look like more than anything else in terms of gold. And to me, the charts suggest that more choppiness and probably some more price erosion is more likely.
Given that long-term gold's going up, and in the short-term gold's going to be choppy, is there a level at which you will feel comfortable adding more gold to your exposure? It's currently at $4,700.
Yeah. I think there's a chance that it'll dip below 4,100. And I think that would be a definite spot to add or establish positions. Effectively, the pattern suggests, David, is that the drop from 55 to 41 was like a wave A, and now we've had this choppy B wave up to where we are right now, and it could extend a little bit more, but I think there's a C wave coming that's going to take it down below 4,100, and when that happens, we will complete at maybe the first leg of the bigger correction. So if that happens, I would expect then gold to rally back up to 4,800 to 5,200. Well, if you're buying under 4,100, that's a pretty good trade.
Is there anything that looks really cheap to you right now?
No.
All right. No. Well, that settles that.
No, again, there are risks, downside risks that I think in the near term exceed the upside potential.
Yeah.
Now, that'll change very quickly. I mean, that's why I said I think there's another shooter drop. But if the S&P gets down near the 6,000, 6,100 level on any of that shoe, I think that's going to be a place to do some buying. And I would buy some of the tech stocks that have seen a big uh, change, if you will, in their valuation level, because they're going to still make a lot of money. So that's an area that I would be inclined. I would avoid financials because I think private credit is going to become a problem, and banks do have some exposure there. I don't think private credit is anything like the 2008 financial crisis, but it doesn't mean there can't be some problems for some of the banks that are more exposed.
By not 2008, you don't mean even if there's problems locally, it's not going to spill over to all banks and the entire economy.
Correct. Because the thing
Okay.
that people forget, David, is that the banks had great exposure to housing prices through the products that they had created, sold, and then they got enamored with them and they left them on their balance sheet. Their leverage was between 26 and 30 to 1. So if housing prices drop by 3 to 4%, that those levered investments were wiped out. That's one of the things that really killed the banks. They don't have that kind of leverage to private equity.
Okay, Jim, I want to show you the labor report that came out this morning. So the unemployment rate is now at 4.3%. U.S. payrolls rose by 178,000 in March, more than expected. We were talking about how oil prices are going to squeeze the consumer and how the Fed's going to react. It looks like this last report looks great for the labor market. I know these reports are noisy. 1 month can change from another, but would you take this report as in a grain of salt and just look at this as a why not one off, or do you think the trend is an improving labor market?
I think I would use the word stable. For a long time, the numbers kept being weaker and weaker. And now it looks like we've kind of baselined a little bit and with an upward tilt. So you're right. Taking each report with a little grain of salt is, I think, always wise.
Look
if
at
we
the
average last
volatility in
month
this
and this
chart.
one, what
Yeah.
are you at? Like 90,000 or something? So the Fed just had a study that said, you know what, we may only need about 10,000 jobs a
Yeah.
month to be at an equilibrium point in the labor market. The one thing I'll note is a lot of people have made a big deal about the revisions that have taken place. And oh my God, that's a big sign of weakness. I've made 2 points. First of all, those jobs never existed. They were created by the birth death model. In 2024, I think 59% of all the jobs that were created that year were because of the birth death model, which is nothing more than guesswork. That really wasn't corrected until late last year. So I think people got, overreacted to some of the revisions on jobs that never existed in the first place, which then explains why the economy continued to be okay while that supposedly was going on. So I think this is a sign of stability. It also, for those who are really, really worried, Waller, I really like Waller, Chris Waller on the Fed governor. He's very thoughtful. He's smart. In 2022, he was 100% right about some things that some of the other governors weren't. And so for him, the labor market has been a focal point. This report, he's not going to look at it and say, "Oh, I'll accept it exactly," without question. But it's definitely going to make him feel more comfortable. He won't dissent again. Remember, for a couple meetings he dissented. Last meeting he did not dissent. With this report, he's not going to dissent at the next meeting either. Moran is going to want to cut because that's where he's at, right? So I think for the majority, if you look at, I've gone through the minutes of the FOMC, and if you look at the terminology, David, the last meeting's minutes, we're like 15 to 16% of the members were more concerned about inflation than they were about the labor market. Well, this report obviously is not going to change their view that they can be patient in terms of cutting rates. And I think that ultimately that's where the Fed is going to wind up being.
I'm looking at this chart here, monthly job creation in the U.S. My first impression is why it's become a lot more volatile in the last 2 years with monthly job creations in the negative 1 month and then the positive in the next. I don't know if these numbers just have to be revised even more, but if you look at prior years, it's just been stable job creation every single month. Some jobs less than some not, some months less
positive
than others, but all positive. And now all of a sudden we have huge swings month to month.
Yeah. Well, part of it is, when they report those numbers, David, I think they have about a 30 to 40% response rate. So that's one of the reasons why you get revisions, because you go out another 30, 40 days. And people who didn't respond when the deadline was for the report subsequently do respond. The other thing, the role of immigration. We had job growth in part that was fueled by the big increase in immigration. That dried up. Immigration is down to about zero. And there are people that are leaving the labor market because they're leaving the country. And so I think a number of unusual factors have come together. And to the extent the Fed is right, and I think they are in the ballpark, that we only need maybe 10,000 jobs to be at a equilibrium point in the labor market. That has never, ever happened before. But there's reasons that have evolved over the last 12 months that got us to this place. So I think we're going to have to get used to the idea of, hey, we got 172,000. And then, 2 months from now, we lost 36,000. I think that's the world we're living in. If that equilibrium point is just above zero, you're going to be going up and down. And that's why using maybe 3-month and 6-month averages, looking at unemployment claims, you get above 250 on unemployment claims. Okay. I would pay attention to that as being, all right, something seems to be changing. So those are all again, I don't see the Fed raising rates because they understand the role of demand destruction. Now, there is a risk. Again, in the 1970s, there were 2 big inflation waves. And I think I sent you a chart showing that. And, you look at it and say, wow, the correlation looks really tight on that thing. We're going to see that chart pop up a lot, I think, in the next few months. Because there are going to be people saying the Fed's behind the curve, just like in 2021. And look at what happened in the 70s. And we are going to see inflation tick up. I mean, the CPI and the PCE, they could be up 0.8% annualized over the next 6-9 months. Other risk is food inflation that is going to follow on. I mean, corn prices are up, fertilizer prices are up. And so to me, that's the second wave of potential inflation. But I think it's important to keep in mind. In 1973, oil was at $3 a barrel.
Oil price drove 2 waves of inflation, says this chart in your report.
Yes. And so the first wave went from $3 to $12 in 1973. By 1979, oil was at $39 a barrel. So effectively, it went up 1,300% in 6 years. So the price we've seen so far today, yeah, it's pretty big, pretty significant, but it's not up 1,300%. Oil would have to be up around what? $700-800 a barrel to be comparable. The other thing is the energy input back in the 1970s was about 8% of GDP, and it's now down around 3%. So those are the reasons why I don't agree with the idea that, we're going to have another big wave of inflation. We are going to tick up. I was writing about inflation ticking up before the Iran war, just because of the way they calculate the CPI and the PCE with the 12-month rate of change stuff. But I think, again, as inflation ticks up, people are going to grab onto this, and say, hey, the Fed's behind the curve, just like they were in 2021. And there'll be people calling for the Fed. They better raise rates. Otherwise, we're going to have the same thing all over again. I think the Fed is going to resist that.
Let me just end on this note, and we'll wrap up the conversation. So I think even if you're not an investor, you're wondering, you're looking at all this news, and you're wondering to yourself, will my living standards improve or deteriorate this year? Let's factor in inflation. Let's factor in Fed monetary policy, the war, and how that's impacting global trade war that's still ongoing, stock market, weaker labor market. Will my life improve or worsen this year, assuming I don't, win the lottery or get a new job?
All those variables. Yeah.
Sure.
Well, again, we're in a bifurcated economy. So for the bottom 50%, their life is already deteriorating. They go to the gas station, it's like, wow, $4 a gallon. In California, I got gas the other day. It was $6.39 for regular. Okay. So if you're a gardener, you're feeling that pinch pretty heavily. So again, the pinch is going to be more directed at the lower income folks. You're feeling it first. Upper income people, I think the bottom 20% spend 6.3% of their income on gas. The top 20% is 1.2%, with the middle class being around 3.5 to 4. So the bite that's coming from this energy thing is, going to be felt by everybody. It's just a matter of degree. So the economy is going to slow as a result of this. It's just a question of how long do prices stay up, and does it lead to employers starting to cut back on employment? That is the determining factor of whether or not we're going to see the economy tip into a recession or not, is jobs. And so today's report is, so far, okay. We'll see what April brings,
Well, thank you so much, Jim. Appreciate your updating. Congratulations once more on being correct on the direction of the market in which you called earlier this year. So let's see what happens the next 3 months. Where can we follow your work and stay up to date?
Go to macrotides.com. Hey, and if you want to receive the April Macro Tides issue, which I cover a lot of the stuff that you and I just discussed, but in greater detail, Jim Welsh Macro at gmail.com. I'll send you it, and just let me know you heard me talking to David.
All right. Thank you very much. We'll talk soon. And don't forget to follow Jim. Links down below. Appreciate it.
Hey, take care. Thank you, David.
And don't forget to subscribe and like this video.